Welcome to another episode of the Mike Smith Investment Show. Today we're going to be discussing Paycom and taking a deeper dive into the company. Currently on my stock positions or picks, I have Paycom rated as my number 2 look and a buy and hold position. So for the past 4 years, Paycom's been declining pretty severely. If you were to invest money in the last 4 years, you'd probably be negative on your investment, depending when you bought the company and when you sold your position. This is primarily due to the decrease growth for their number of customers, as well as their large reliance on beta. I believe you pronounce that beta, which I'll dive deeper in. So Paycom is a payroll company. It creates software for businesses to simplify their payroll, view and compare future and present employees. They have a lot of implemented applications operating in one large database. So it is a intangible asset company, which decreases their overall expenses as compared to a tangible product company, such as Nike, where they actually have to buy products to make their product. So the expenses are a little bit higher in Nike. Beti, like I explained, is their top application and their biggest seller. I personally use this for the current part-time job that I use. My company uses this. It's a pretty straightforward application, and they have a very experienced and educated team of software developers that make these applications easy for their consumers and customers. So they also make a bunch of different other applications, but as I explained, they've had a large reliance on Beti, so this is definitely their top seller. Recently, the stock has been increasing, as we can see from its low of about 140.50. So financials, they have been increasing their revenue since 2017, as we can see by this chart. They have not released their 2024 annual revenue, but they have seen a increase year after year. And by country, they're primarily operating in the United States. It was stated in their 2023 annual report that they will have future developments in non-domestic marketplaces such as the United Kingdom, Mexico, and Canada. But they've kind of decreased their revenue growth and number of customers. They initially started working with small companies, helping them simplify their payroll and reduce their expenses. Now they want to switch that and start focusing more on larger businesses and or corporations, which could potentially give them more money and a higher revenue growth overall. Earnings isn't really something I primarily look at when looking at a company. I think it's somewhat speculated upon, but their quarter one earnings reported was $2.59, and their estimate was $2.45. For quarter three, the reported was $1.67, and their estimate was $1.61. So their earnings per share are going down. If you use that as a metric for whether or not you should invest in the company, that is definitely something you should look at. Dividends. They do pay out an annual dividend of $1.52 per share. That's higher than Apple. So if you were to invest in this company and the stock price were to decline, you would have some type of backup with a very strong dividend and a very strong dividend yield right now of 0.73%. Strong in the sense for their company, but not strong in the sense for a overall look on a dividend yield. I like to see around 7%. But I believe that this will continue to go up. Depending if the stock does rise, we will see a decrease in the dividend yield, but not primarily a bad thing. And I believe that they will try to increase their dividend amount of 37 cents quarterly. to hopefully around 50 cents, but I don't believe we'll see that anytime soon. I think they're more focusing on a higher growth, revenue growth. So, overview, a really attractive thing about this company is their debt. They have a very low debt of around 75.95 million. Their cash flow is 292.45 million, so they can completely cover their debt, and their cash and equivalents are 294.02 million. When looking at a company with no debt, it's very attractive. You don't really see companies without any debt, and this is a company with really no debt. They can completely cover it, so that's a very good thing about the company. Their financial positions, they do have more long-term assets than liability, as well as short-term, which is another attractive metric when looking at the company. If we look at their quarterly revenue and earnings, they have been able to hit their estimates and have some surprises for this quarter. Quarter 4 has not been released yet, and we are still waiting to see that number, but I believe that they will, if not hit that estimate, maybe have a surprise to their earnings and revenue for quarters. So the way they make their revenue is through reoccurring payments. This is another really good thing about the company. This allows them to have reliable customers that will continue to pay if they do stick. So revenue is a somewhat reliable metric for this company, as their clients do pay them through a reoccurring payment method. Now, valuations isn't something I primarily look at, really, but it is important to look at. Honestly, I like to see the profit-to-earning ratio go up, which it has. From quarter 2, it was at 17.25. Quarter 3, it's at 20.05. At an annual basis, it has been declining. It was at 64.15, and now it's at 35.17. I think this is due to them, the earnings per share decreasing, as well as their stock price decreasing significantly, as I explained previously. So if we take a look at their discounted cash flow statement, we can see they have a fair price of $256. Their current price right now is $206.20, so they are a undervalued company if you look at the discounted cash flow model. And they are presenting a 24% upside. This is not a exact valuation by any means, but it does give some leeway with this range. But right now, it is currently a undervalued company. If we look at their future growth as represented through Seeking Alpha, they do have a very attractive forward revenue growth of 14.29%, and their year-over-year revenue growth is 11.92%. These are really good really good numbers, and something you want to look at if you're going to invest in the company. So if we look at their peers, Paylocity is definitely their top competition. Some of these other, like Dayforce, Robert Half, TriNet, and Attico, I believe you pronounce that way, they're somewhat below Paycom. So Paylocity is definitely their highest competitor. If we look at total revenue, Attico is actually above them, but Paylocity, Paycom, is down at the bottom with 8.2 billion as compared to Attico, which is at around 26 billion. All right, now we can take a deeper dive into their financial statements and ratios. For gross profit margin, they've seen a slight decrease from 2019 to 2023 in the past 5 years, with a 1% decrease. Their operating profit margin has also decreased, and a 1% decrease in the last year, 2022 to 2023. Their net profit margin has decreased significantly. This is primarily due to the fact that they are struggling to find substantial growth in their customer basis. Their debt ratio did decrease to 1%, and their free cash flow standing around 434. This number is not accurate, but the numbers, that 434 can kind of tell you that there has been an increase since 2022 to 2023. The return on equity has also increased by 2%. Now for sales revenue, they have had increase after increase year after year, and a 23.16% increase in sales revenue from 2022 to 2023. Now net income has also increased, and it's increased around 21.11% from 2022 to 2023. Their free cash flow has grown significantly year after year, which is a very attractive measurement for the company, and they've seen a 25.83% increase from 2022 to 2023. So some of the stuff I did not show you was they are having a share buyback program, but it has been slowly declining. They have returned over $365 million to their shareholders as well in 2023. Some of the risks associated with them is their large reliance on that program beta, any economic policies associated with the Feds and the Trump party, and their large increase in competition year after year. Overall, though, I do believe that this company has a healthy fundamental side, and with their future developments in United Kingdom, Mexico, and Canada, they could see increase in revenue, as I would like to see. I want to see them kind of slow down on their reliance on that one main product, but it's a effective product, and they've been able to increase their revenue. So if they expand on the development of that product and offer new services within it, I think that we could see an increase in revenue. They have a subscription-based revenue, so it's very predictable revenue, and the scalability of their sales channel and software is very high. Within that, it's an intangible company, which I like to see, as their expenses are a little bit lower than a tangible company, such as Nike. And they're focused more on now larger businesses and corporations, and implementing them with this software could heavily increase their revenue, as well as their large increase in free cash flow. So overall, I think that the company could have a potential for upside. If not, they have a very strong dividend. As I've said in previous episodes, I am not someone who will buy a company for a couple months. I like to hold the company for a year, if not 5 years, 10 years. But I think if you are to hold this company, it has potential for future growth if they do implement this initiative to focus more on larger corporations and expand their markets to non-domestic areas. So thank you guys for watching this episode. On Sunday, I will publish a weekly overview of what happened in the stock market and any big news that could affect big indexes or companies. So thank you guys for watching.